Hi, everyone. Good day. Welcome to our M&A series on business valuations. Today we have two very special guests, Darren Mize and Monty Walker. We're going to discuss the right timing for the sale of your business and the tax implications based on the current environment. Let's do a quick sound check. Darren, can you hear me okay? Monty?
Yeah, I can hear you.
Okay,
I can hear you.
Perfect. Well, welcome each and every one. I appreciate you guys taking the time to join us today. Our company is called the NYBB Group. We are a boutique merger and business advisory company based in the New York area. Our headquarters is in Melville, Long Island. We service the tri-state area and also nationwide. We provide multiple services between sell-side and buy-side advisory services. We help clients who are looking to exit their company, get them on the right track, get them prepared, and position them for sale. We also help companies expand as well. Over the past few months, ever since COVID, I've been getting so many questions. I could tell you. I mean, I'm sure my colleagues can share the same sentiments as well. COVID has impacted us dramatically, and many businesses across the U.S. It's been a tough situation for many companies. And the number one question that I get from companies is, how has business valuations affected how has COVID affected their business valuations, as well as should they sell their business now or hold on till next year? Obviously, no one here has a crystal ball. We don't know what the future holds, right? This is some unprecedented times. We don't know if the pandemic is at its peak or if it's going to be past anytime soon, or if the economy is going to recover at a rate that most business owners would like. So in this webinar, we do hope to, and we will, in fact, cover three learning objectives. One is, what's the new normal when conducting business valuations? The second objective is going to be, is now a good time to sell? These are the top two questions that we've been getting, impact and valuations and the timing. And we're going to get a little bit into some best practices, and we talk a little bit about the tax situation with the coming election and so on. So we're going to kick it off. A little bit about me. I've been in this business for 10 years. I serve as a board member on the International Business Brokers Association. Prior to doing this, I've owned several companies, which one of them I still do own. I'm heavily involved in the M&A space. I do stay in contact with a lot of my colleagues with my affiliation. We're in different associations. So I try to keep a good pulse on the market as far as what's happening so I could best advise my clients. And a couple of those conversations with some of the folks that you're going to hear on the call today with Monty and Darren. So I'm going to turn it over to our speakers for today's talk. Thank you for taking the time to speak today. And you're up, and you can get your slide up. For some reason, it's not loading. Okay. You're good to go, Monty. Okay.
Okay.
There we go.
All right. Well, I appreciate the opportunity to be here. Hopefully, I see the latency happening. Hopefully, everybody can hear me okay. Being in the M&A space and doing the work that I've done, I've been able to have an opportunity to work with literally thousands of business intermediaries over the years. I've been working with in this space probably at 25 years, and so a lot of positives, a lot of negatives, and I can say this right now: the issues that we're facing for COVID are very unique, but the issues that we're facing with the election, they rotate around every 4 years. So we're facing some of the same issues, and it should not drive whether somebody wants to sell their business or not. We'd have to keep planning, and we keep forging forward as far as that's concerned. That's what intro there about my background being that my focus is entirely in helping people transition companies completely.
We lose Darren. Okay.
Yeah, no, I'm back.
Okay, great.
Okay, so pleasure to be here. Thanks, Kyle and Monty. So GCF Valuations is based out of Tampa, Florida. We're a business valuation firm. We specialize in valuations of privately held companies. We don't focus on any one particular size, but the majority of the work that we do generally falls within the $5 to $20 million range. We serve merger acquisition clients, primarily business intermediaries, M&A firms, and SBA lenders. And as Monty had mentioned, what we're seeing right now, some of which we've never seen before, and a lot of which we've seen before. The election definitely plays a role in M&A activity. We're seeing a lot of it right now on our side. But from the pandemic point of view, we're seeing a lot of businesses that are doing well and a lot of businesses that are struggling, and quite a bit of few in between as well. So it's definitely something new that we've experienced, but having been around for 23 years, we've gone through 9/11, we've gone through the Great Recession. So it's not entirely abnormal to see what we're seeing in terms of an economic event, but it's certainly a unique component of how we're looking at this from a valuation standpoint. So hopefully we can answer some questions today and enlighten you on some of the things that we're doing and what we're seeing in our space as well.
Thank you very much, Darren. So we're just going to, you just want to bear with us. We are experiencing, some latency, some technical issues, but for the most part, we are broadcasting, we are live. What you might want to do is any questions you have for the panel, there is a Q&A section. You can submit it there, and we definitely will get those questions answered. So the first topic, and we're just going to jump right into it, Darren and Monty. We know COVID has impacted business valuations, but what are you seeing right now in the marketplace when you're reviewing these companies? What is the impact? What are you seeing from a valuation perspective, and how has COVID-19 impacted business valuations?
From our standpoint, what we're seeing obviously is a shortfall of about 1 or 2 months. So a lot of the businesses that we're looking at right now are in fact showing little or no activity in the months of April and May, with some activity showing up in June, and any rebounds at all that we're seeing is happening in July. So the impact is there, and we're seeing it with the majority of the businesses that are on the market trying to sell. And a lot of the businesses are going through SBA financing right now. So many lenders that we're working with have had to put a pause on some of those transactions, but many of them now are starting to flow through again. The rebound is occurring. So we're definitely seeing some improvement in how businesses are performing financially. They're still well below where they were a year ago in terms of year-to-date pace, but the rebound is definitely there, specifically in July and August. And assuming that we continue to see the rebound, things should start to improve pretty significantly here in the next couple of months. But we're just too current at this point. We only have enough data typically through July and August. So what happens after that, we're not really sure yet. But the impact is there, and it's being seen across 85% of the businesses that we're looking at right now, where the value impairment is going to be well below where they were in terms of value just a year ago.
Mm-hmm. And, Monty, do you share the same? Are you seeing the same thing in your work?
There's a component of that I find true. The unknown really right now is where the value impairment is going to go. You got a couple of months. For some businesses, that's all it was. It was an anomaly down. A great example: companies that might be that may have contracts in place, maybe construction related, renovation related, whatever. Those things came to a halt. All of a sudden, they're ramping right back up. So those would be more of an anomaly. But you go to the hospitality industry, there's a value impairment just because of the industry. It's been decimated because of the industry. And but I can say this on the valuation side, there are people out there now, buyers, who are going to be looking and already are looking to use this as a justification to claim that the values on a business have dropped dramatically. And that just absolutely may not even be the case, but they're using it to their advantage. So make sure on the valuation side, reputable valuator, make sure you get good support to know what the real values are. Do not succumb to a buyer in the pressure that the buyer may have by trying to claim that the value on the company's been impaired when in fact it may just been delayed. And a whole company's history isn't impacted by 2 months.
Exactly.
Yeah.
It's a good point, Monty. How are you handling that in the recast? This loss of revenue. Are you adding that back, or are you putting together some projections? You're doing, I'm assuming, discounted cash flow method. I assume, right? how are you handling the recasting of financials currently?
You mentioned the discounted cash flow method. Unfortunately, what happens is there are a lot of advisors who are kind of migrating to maybe use that methodology, but it can put a value astronomically high if you don't know how to use it. So you got to use that properly. But the key on the recasting is how did the financial records really show the financial results for the last 2 or 3 months? PPP loan. Unfortunately, what's happening is the PPP may have been included as a normal income stream. Well, that throws ratios off. It throws all kinds of things. Well, the PPP loan should have been included as a debt. And then it gets included as income after it's been forgiven. It gets moved over as a debt forgiveness item. So you have to make sure the financials are in order. And then from there, dependent upon whether or not you have expenses or income that needs to be recasted, then you would recast. So if you are recasting from a tax return, as an example, tax returns, at least right now, until IRS changes their position or Congress changes it, you don't get a tax deduction for expenses, but you also don't get the income. So if you're recasting from a tax return, and you're going to recast differently than if you're recasting from a financial, because the expenses will be there on the financial statement. And they may have completely accounted for stuff incorrectly. So recasting is critical. Make sure that you do take into consideration the PPP, get one-time adjustments in there for PPP activity. So you have it in everybody's face, but you do have to take it into consideration.
Monty, I'm going to come back to you. I want to expand into the PPP point that you made. I'm going to come back to you in a second on that. Darren, your thoughts on recasting?
From our standpoint, we're not doing it. At least from a valuation standpoint, we're not doing anything differently in terms of recasting in general. Obviously, with the PPP income and the debt, obviously that's got to be treated a little bit differently. But what we're trying to do right now is really look at what cash flow looks like now versus what it looked like a couple of months ago versus what it looked like pre-COVID versus what it looked like in 2019. We're really just trying to figure out where that bottom was so that we can start looking forward again. As Monty mentioned, discounted cash flow is certainly something that we look at. We believe that if done right, you can project out a value that's representative of the company's financial performance. It is a slippery slope, however. What we're trying to do is really look for that support, meaning that we're trying to determine if it's just 1 or 2 months and the rebound is in place. There's simple ways to support that. I think for any business owner, as Monty said, that can support the rebound and that they were actually just delayed as opposed to completely shut down and having a difficult time recover, there's value there that needs to be recognized. And, our job as appraisers is to try to find that value. So our key focus right now is making sure that we can start seeing that rebound as quickly as we can. And if we're looking at July and August as a way to compare that to, if they're looking the way they look pre-COVID, then, we're really just not even looking behind us anymore. We're looking forward again. And I think that's what we're trying to do, is make sure that we value the companies properly, that where that's warranted. Obviously, there are many businesses in the hospitality industry that are suffering right now. Not much you can do in terms of value there, but there are lots of businesses out there that have just delayed orders, have delayed customers. Those things are starting to roll through right now. So if you're seeing that and you can support it, the value's there. And we're not treating recasting any differently in that case. We're just making sure that we can calculate cash flow properly and look forward so that we can capture that value where we can.
So, Darren, let me ask you this. So you have a business and their sales are down and looks like the orders are delayed. At what point would you suggest they get a valuation? Should they wait till their revenue come back and they can do some projection based upon that rebound, or should they do a valuation now? Like, at what point you suggest they at least start having a valuation, have someone even look at their business before the rebound or after?
Preferably.
I preface this as a company that's planning to sell, not someone that's not looking to sell, but someone's looking to sell in the next 1 or 2 years.
Well, I think obviously the focal point here is that rebound. You got to find the bottom. And if you can find the bottom and show that the company now is moving its way back up off that bottom, what you're looking for next is that revenue that's coming back and how quickly. So, for example, we saw a company out of Atlanta that dealt in retail beauty supplies. They were shut down for right around 6 weeks. And a good example of the rebound is that when they reopened, they were showing average daily sales that were exceeding where they were pre-COVID. In the first couple of weeks, in fact, that increase was significant, and then they started to pull back a little bit. So the point from our standpoint in terms of value, and those business owners that are interested in selling, ideally you want to be able to show the rebound, and if you can show that rebound, then that's the right time to get that valuation done and to get that business on the market. If it's there and you can support it with documentation, and by the way, it doesn't have to be hard documentation. We're looking at daily revenue sheets, weekly revenue sheets, whatever can be provided as a means of support and a benchmark. And if you look at the business going into March or April of 2020, and then you look at it on a month-to-month basis in all of 2019, and you get a general trend of what they look like month to month, week to week. Obviously, you got to identify seasonality if it's in there. If their revenue figures and their P&Ls are showing that the rebound is there, then I think that's a good time to get moving on that listing.
Client together, Darren and I know your services is flexible. So this is a client has actually had a valuation done prior to COVID, and the valuation can always be updated to reflect the current numbers. So even if you were to start one prior to a rebound, you can always have that valuation updated as well. Just talk about some of the business value drivers that business owners should actually look at pretty closely. That could actually impact them. Now, there are some businesses actually doing well. However, like for example, in the PPP space, personal protection equipment space, a lot of businesses done well, but now there's so many companies in that same particular market where sales in that space has flattened. You look at like liquor stores as well, right? Liquor stores did very well at the high point of the pandemic. Are you making, before I get to that point, what value drivers are you addressing? Like for example, like accounts receivable, right? So some companies maybe had a lot of money out there that they need to collect on, but which can be a good thing, but in a sense where if those customers are out of business, not doing as well, you may not collect on those funds. Give me some ideas, draw some pointers on what value drivers business owners should actually look at, for those that are thinking about exiting their company.
Well, I mean, I could saying that the primary value drivers of any business is going to be its cash flow. In this particular time, you want to make sure that not only are you able to identify that cash flow where it is now, where it is prior to COVID, and where you think it's headed, but now you got to start looking towards the balance sheet as well. Especially many of those businesses that have been shut down for a period of a month or 6 weeks or even 2 months. Working capital now comes into play. You want to make sure you have plenty of liquidity to get through those short months where you've got little or nothing coming in. Obviously, the PPP was great for many businesses out there that could keep their staff on place, because then you're in a position where if you can just hold on with some of that working capital, you can keep everybody in place, and you don't have to worry about furloughing anybody. You don't have to worry about going out and rehiring and retraining a whole new workforce. The other aspects that we look at right now are, supply chain and customer chains. Some businesses may not be affected, but some of their clients and vendors have been affected. So that actually has an interruption on that business as well. So you've got to look at all of those aspects to make sure that when you're looking forward, that everything is in place to get this company back to where it was before. And that's many of the key variables that we're looking at right now.
Thank you. And Monty, and you can jump right into the PPP conversation if you like as well, because that definitely is factoring into cash flow right now as well.
Oh, there's no doubt. When you start talking about the value drivers too, that pipeline, a lot of people have a strong pipeline, and they didn't, that just built up. So people who are looking to sell, the pipeline is going to be a critical value driver for people. Now, when you start talking about the PPP funds, that there's a two-prong effect on that. It was great that they have it, but now all of a sudden it's a testing issue. It's a problem as they go to sell, especially if they're going after SBA funding. So now you've got an issue of buyers having to come in and take over the loan. But the problem is you have sellers who are having to put up escrow accounts. So depending upon how big of a deal they have, now a huge amount of their money is getting locked up as they start to sell. So the PPP funds, very careful on that it does not appear that the PPP funds have added anything to the asset base or to the cash flow. You cannot make a huge mistake if there is somehow a balance sheet that's included in the transaction and PPP dollars are sitting on there unused, and that hasn't been fully disclosed. That overstates the real position of the company. And if there's dollars carried in the cash flow side, that's got to be factored back out also. So as much as it could be a positive to enhance, these drivers are actually a deterrent. It could come back and be a problem. So if PPP is involved, got to make sure the balance sheet's not adversely affected by by the transaction and also the income side of that with the cash flow. You got to factor it both in places.
Mm-hmm. Are you addressing the same way in your recast, Darren?
Yeah, same thing.
Same. Okay.
Yeah, same thing.
Perfect. So we're going to jump to the next topic, and we talked a little bit about value impairment. But the other big question we get in now is now a good time to sell? It really depends on that particular business owner. A lot of times it's health driven, like you've been through. A lot of businesses been through a previous recession. Now with COVID, this is more health related, and health is your priority. Your family is your priority, and might think, you know what, this might be my last go round. I don't think I could go through this anymore. Might make sense for me to exit right now. So we're seeing the pandemic actually creating a trigger effect for a lot of business owners to shorten their time frame when it comes to selling. But is now a good time, or should they hold on? Like, I know there's some industries that are affected more than others. What are you guys' thoughts on this?
Monty, you want to go first?
Yeah, I believe now is as good a time to sell as yesterday was and as tomorrow will be. Now, what has happened here is this has turned the lights on for some people who thought they were invincible. And there were plenty of people that had businesses that they have reinvested everything they have back into those companies. They never worked on them. Never worked on them because they were always working in them. They've never diversified their retirement assets. And one day something happens that they can't control, and it was called COVID. And now they realize that they are invincible. And so now they're opening their eyes to say now it could very well be a good time to sell. Now, going out and saying I want to sell doesn't mean you close the thing today. It means that I'm ready to sell. So they need to get with a professional and start working through that process. And there very well could be somebody today. And here's the reality. You don't have to say yes. Now's a good day to sell. And if the buyer on the other side of that is trying to negotiate for a level that's just not acceptable, then you say no. But also, now's a good time to sell. So you start talking about where you sit, what are your value positions, and if you need to enhance them, you start working on them. So saying now's a good time to sell, that may be a plan, and it also may be the fact I'm ready to go to market. But yes, I think now's as good a time as it was yesterday or the day after, because we know one thing's for sure, COVID ain't going away. So right. This is going to stay. We better start learning how to work through this thing and keep life moving.
Right. Darren?
Yeah, I would agree. I think, a couple of things that we've seen here is over the years that we've been doing this, activity is good. And right now there's a lot of activity, and that's because buyers are seeing opportunities. I think sellers are seeing opportunities. The one thing that I've really enjoyed watching over these last few months is that, business owners have been forced to become entrepreneurs again. They have to rethink how they do their business. They have to rethink, what their business looks like. Is it a good model? Can it be improved? And I think that's a great thing, because when you get into entrepreneurship mode, you start thinking a little bit differently. You start going outside the box. And I've seen a lot of businesses improve over the last couple of months because of that. They were down. They had a little bit of time to think about it. They retooled and rewired everything, and they came out of this looking really, really good. So I would agree with Monty. There's now is as good a time as any, and like he said, doesn't mean you have to sell tomorrow. Just means that you have to commit to it. And when you commit to it, and making sure that you have an idea, one, of what the value is of your business now, and maybe where you want it to be. Sometimes those two numbers are the same. Sometimes they're different. It gives you a starting point. And as long as you've got a starting point and you can see where you want to go, all you got to do is fill in the gap and figure out how to get there. And as all business owners are, they get creative and they start figuring out ways to get there. And I think there's a lot of opportunity out there for business owners today. I think there are a lot of new markets that can be identified and taken advantage of. And I think that there's some good opportunity here to build as opposed to constrict. And I don't have any doubt in my mind that people are taking advantage of that, both on the buying and the selling side. So it's definitely a good time right now. Lots of activity going on out there for sure.
Got it. And can you explain for those that are in attendance of what is value impairment, and we can probably segue that into some of the industries that were adversely affected and so on.
Well, I would just say because value impairment you can have a whole class on that. I think just to keep it simple, the way we try to explain value impairment to our clients is whether or not the company has been impacted at all by an event. All right. So that can be an economic event. It can be a customer event. It can be a management event. But in this case, obviously, we're talking about a global pandemic. Obviously, it's a big event. Value impairment is anything that inhibits the company's ability to perform at or normal levels. So what we're trying to do here, as we always talked about, is when you're looking at value impairment, some businesses were not affected at all by this pandemic. If you look at primarily essential businesses, a lot of e-commerce businesses, liquor stores, grocery stores, gas stations, C-stores, you've seen a lot of the businesses that have been open through this entire period. So those businesses really don't see much in the way of value impairment unless their customers have. So we have to, as I mentioned before, you look at value impairment through the company that you're looking at. You're looking at it through their supply chain and their customer chain. So there's probably a small percentage of those businesses that weren't seeing any value impairment at all. There were some that saw it short term, but have rebounded back to perform where they were, back in February or March. And then you've got others like the hospitality industry that obviously are suffering right now. So, I think if you look at it from a common sense standpoint, the biggest impairment that you'll see in any particular industry are those industries that were considered non-essential, or those businesses and industries that were shut down for longer than a month or two. I would say you've got probably a good 20% that weren't affected. You've got another 50% or so that were moderately affected, and you've got another 30 or 40% that were significantly affected. And if you look at it from a simple equation, value impairment is an interruption of cash flow that hasn't returned yet. If that's occurring, then you're going to see some value impairment. And what we're trying to do is look at it from now versus where they were a year ago versus where they were just a couple of months ago. Ideally, you want to see that rebound, and if you can find and support and identify the rebound, I think that you can limit that impairment as you look forward.
And Monty, do you want to address? I would like you to address the tax situation right now and potential changes in the future. We can talk about it from a timing perspective. What are your thoughts?
This is one of the most challenging issues. I guess it's kind of in front of us right now. If the unknowns that are coming with the election are the biggest issue. I mean, that is the biggest issue. Are we going to see a major tax increase because one party takes over? Are we going to see a stay on where we are with a possible decrease because another party stays in? That's the biggest issue. Now, I know Trump has come out and made a statement about lowering capital gain tax. Right now we have a 15% or 20% capital gain tax, depending on your adjusted gross income. And for most business owners, they'll run into a 20% if they got any sizable business whatsoever. And he's talking about dropping it down to 15. So could there be a benefit, a 5% benefit that could come in the future as a result of selling? The answer on that is yes. If you wanted to take advantage of a lower potential capital gain tax, that means you have to step in and maybe do an installment note. There are other techniques, but for future delaying into the future periods, you would have to work out a strategy to delay into those future periods. And then because on installment provisions, if you collect in the future years, you get the tax rates that are in play in that time frame. So now the other part is, how about the C Corp structures that we see right now? You're sitting at a 21% federal rate. One party has already said that is going away. It's going to go up. So if you're sitting inside of a C Corp, all of a sudden now you start thinking about changing and getting out of that thing and getting into an S. My statement on all of that is you have to continue working exclusively with what you know. And if you try to make everything a decision based on what you don't know, you'll usually make the worst decision, because people are natural. If they don't know something, they fill the void with the worst possible outcome because they're looking for worst possible result. So I think we work with what we have right now. We do not know how the election is going to go. And so you just work through where you are, be nimble, so that as you get down to November, if it's in the middle of October, I think it's prudent to say we might want to wait till November the 5th and find out who wins the election. But where we are right now, let's keep forging ahead. But if you have the ability to delay it a little bit so you can see what the outcome is going to look like. But I think you need to keep making decisions based on what we know right now. And that is, you got a 15% rate if you're really below about 480 grand of adjusted gross income, 20% rate above that, 21% rates that you have in the corporate C Corp structure. And then we have all the other planning that we do on either side of that. So don't be haphazard. Don't let all of the stuff we have going on right now paralyze, because that's what can happen. You can get paralyzed and you'll never make a decision. So just keep going.
So are you saying, Monty, you're going to see some friction between buyers and sellers as far as closing dates is concerned? Some sellers want to push things back after the election, see what happens?
Yeah, sellers. Yeah, there's no doubt. Sellers are going. Now, right now, we don't have such a problem. Why? Because people are trying to get SBA loans. They're pressing for that free SBA money, right? So,
Right,
I mean,
right.
and buyer and sellers know that too. So if they really want to sell, they're motivated. Well, after that's done, and now we're in October, now that's probably where it's going to come. So, do I believe that there will be something happening there that will be a friction? Yes. And you want to know where the biggest friction is going to come? It's going to come because the lenders are trying to get things closed and these sellers are trying to hold out. The business intermediaries are wanting to get things closed. We know why that is. So we want to get things to the closing table, because the longer a deal stays open, friend, is no time to a transaction. So we want to drive it on in. So I would say that from an advisory perspective, we keep driving the train. And that's what I would say to any engagement I'm advising on, where I'm trying to help an intermediary get their transaction across. I'd say I'm not going to be an active one to say delay. Now, if I'm 5 days away from an election, I might say that. But right now, no. Keep on moving it. Don't let the friction get you. But yeah, we're going to see some friction for people trying to delay because of the election.
Yeah, I think a few months back, the big push was to get deals done prior to, I believe, September 25th, right? We have that 6 months payments from the SBA payments closing prior. We've seen a lot of that. The next push is going to be, I've had some conversation with some prospective clients that actually want to get out this year because they're predicting that a particular party will win the election, and they have, that corporate tax rate is going to go up. So we're definitely seeing that as well. So it's really a tough call. No one has a crystal ball. I guess you have to play whatever you have. We work with whatever we have in front of you for the most part. Relying on all those external factors can just delay the deal and essentially not get your business sold. So I think the first step, right there, Darren, is getting an evaluation done, see where you're at, and look at the cash flow numbers, look at the balance sheet, and make a call at that point whether or not you need to exit or you need to do some value enhancement for your business. Waiting to see who comes in and what taxes in effect. It's a tough call.
Bet you can manage through it. The key thing is, unfortunately, this issue of tax is a reactive process for most people, and they need to be proactively dealing with that. And some of the worst culprits in dealing with tax come out of a business intermediary. And I'm saying that these are colleagues that I see that I've worked with and trained on how to deal with tax matters. But that's how come I know. It's one thing that people don't want to talk about because it can cause a seller to rethink what they're doing. Nobody wants that. So you let it hang out there until the 11th hour. And then all of a sudden you wonder why things are starting to fall apart. I've never understood why people would let themselves go for 11, 12 months working on something, knowing they had this issue. It kept them busy, that's for sure. But then all of a sudden the deal falls apart or stops because nobody dealt with the tax problem. So it's proactive. You can work through a lot of this but here's one thing I know for sure. Sellers typically will sell even when the taxes are not great if they are prepared for the deal with it. If they find out at the last moment, that's when they flinch and they don't want to close. If you know early enough, then they will go ahead and close. So deal with it proactively.
Yeah, I couldn't agree more. It's that frog, right? You want to eat that frog. You want to get over that hump. That and the retirement plan as well, as far as what's needed for retirement. You don't want to wait till last minute, figure out what net proceeds is, and then figure out, you know what, I think I need an additional 500 grand from this deal in order for me to retire. We did have that happen one time. So so we're going to move on. So we want to talk a little bit about some tips and best practices. Monty, you want to talk a little about hardship distributions and how does that work?
Yeah, this is something that's available right now for buyers. This is a buy-side issue. Under the CARES Act, people were allowed to take hardship distributions from their retirement accounts. And that is a IRA, 401k, the same. So whether it's a group-based plan or an individual retirement account, they can do this. The hardship distribution can occur up to $100,000. That $100,000 can be done without any distribution penalty. So regardless of age, you can get up to $100,000 without any penalty whatsoever. Then the taxes that are due are not immediate. Taxes are due, they can be paid equally over a next 3-year period, or the dollars can be recontributed each 3 years back and never have a tax whatsoever. So think about buyers right now. One of the avenues that people would use to get access to retirement funds is through the rollover business startup strategy. This is not that. This is completely a separate issue. So there are buyers right now that could very well qualify to get these distributions, pay no immediate tax, no penalty whatsoever, and defer even paying tax into the future years. So they can finally have the money in future years to pay the tax when their businesses are producing. So think about that. 100 grand available. You don't have to go through extreme structuring. They don't have to have C corps like they do in the rollover business startup strategies. They can have LLC or they can have an S corp. So they're not limited on their structure. So any intermediary here today or a business buyer on listening to this today, think through that. Do you have retirement money? You can get up to that much. And if you need 100 grand or less, you need to think about this being the strategy. Here's the key thing though. You have to prove that you were impacted by COVID. So you have to show that you were adversely impacted by COVID. So your family members, that could be a spouse, if you've been impacted by COVID, that means you may have had COVID. You may have had a financial matter that happened. You're downsized in your job. It could be a number of things. If you can show you were financially impacted, you qualify.
Mm-hmm. And that would that affect them if they own a business, or doesn't make a difference?
If they own a business, whether they be a corporate owner or an LLC, an equity type owner, or if it's a sole proprietor, either one, if they have a retirement plan and they're currently in business and their business was impacted by COVID, they got financially impacted. So they absolutely would qualify. So anybody that's qualified, whether you're a current entrepreneur or whether you're a budding entrepreneur to purchase a business, this is an avenue that's available to you as long as you were impacted by COVID. Up to 100 grand of money can be taken out of a retirement account without paying penalty and deferring the tax at the same time.
Mm-hmm. That's definitely a good one. Good information. Darren, I want to tee back over to you and just talking about financials, having clean records and books, and that's the importance of that even more so now during this pandemic, especially if you're going through a sale. We have seen some cases where sales has been delayed because of companies not practicing GAAP. And not having clean financials, period. So what's your take on this?
Well, I would suggest that anybody who's thinking about selling right now, obviously, be as current as you can. We've always suggested, especially if you think that your business is going to qualify for any kind of an SBA loan with a prospective borrower, the lenders are looking for clean financial statements. That means tax returns for historical. If they're available, obviously, audited, CPA audited or reviewed or compiled sometimes will work as well. But the cleaner, the better. The more current, the better. Typically, on the valuation side, there's nothing wrong with having financials maybe 2, 3, 4 months old, as long as the business is generally consistent. In this particular time, however, I think keeping as up to date as you can is definitely preferred because as we've talked about, throughout this discussion, especially if you've been impacted in any way at all, you want to make sure that you can support that the business was just impacted for a limited amount of time. And the best way to do that is really just to be able to show that the bottom is over, the rebound is happening, sales are increasing week over week, month over month. This year versus last year, that's the easiest way to do it. So if you can do that, definitely the importance of keeping financials is close to today as possible, even if that means you can't do a full P&L, but you can do weekly revenue sheets. That's whatever it is that you have available is going to benefit you as a seller in the long run, and it's going to help you support maximum value of your business as well. So at this particular time, and probably for the foreseeable future, at least until the end of the year, if not longer, up-to-date financials is a extremely important component right now if you're listing your business for sale.
Monty?
There's no doubt. The accounting process is so critical, and the financial data, sometimes it's the perpetual changing retained earnings balance, right? You go back and look at a financial statement, it's different the next day. How in the world does that happen? So people need to maintain their accounting records, but more important on this, make sure as you're doing the accounting, make sure when you're doing these transactions, you be careful on how you're accepting things such as references to GAAP. Glad Darren mentioned that. A lot of smaller businesses, and I'm talking about businesses that are doing 4 million, 5 million, 10 million in revenue. Okay, these are all smaller. It's all relative. They're maintaining your accounting records, not per se exclusively on GAAP. So they're not doing all the accruals and the things that you need to do. So be careful when you're doing that. Maintain your records, keep them up to date. You need to maintain the details. But when you get into a transaction, make sure the documents are not referencing something that's not so. I've got an advisory engagement right now. They reference GAAP in the calculation for working capital. They ran the working capital calculations on the target numbers and the historical without it being GAAP. Now they're doing it on GAAP. It's creating all 300,000 to 500,000 variance to the benefit of the buyer in this transaction. Because of that, they should have done the historical on GAAP. That's being resolved now, but that's the kind of problem you can run into when you start dealing with the GAAP matter. So keep financials up to date, but once you get into the deal, make sure you're referencing your accounting methodology correctly.
Got it. Good points, Monty and Darren. Tips on, this is a very delicate topic, but it's an important one, right? So any tips on how a business owner can actually defer or save money in taxes when selling a business? Any tools that you can recommend?
Yeah, there's no doubt that the allocation process is critical. Be careful in how you're allocating the purchase price. One of the things I would say that I see happening often is large amounts will sometimes find themselves on a non-compete agreement. Now, if you are intentionally trying to allocate, that's one thing. But if you're selling an S Corp or an LLC, pass-through activity, anything on non-compete's ordinary income to a seller, it gives no benefit to a buyer. Now, the attorney involved with the buy side may say that strengthens my position in the event there's a breach, but that's the only thing that's there. So be careful on allocations. Earn-out issues are coming. There will be more seller financing. I know the SBA has an issue on the earn-out thing, but as more transactions may find themselves with seller financing, be very careful on earn-outs. If there's any reference in the earn-out provision that makes it remuneration for services, if there's anything that ties that earn-out to a continued service delivery or oversight from a service perspective, then it's just an alter ego for a comp agreement. Ordinary income will all of a sudden creep in, and it won't be capital gain when it may have very well should have been. So make sure that is an issue. Another point, since I'm throwing a few things out, C corporations. Inside that C corporation, code section 1202, that's qualified small business stock, very well could apply to those who have C corps. And if anybody has started a C corp or has gotten stock from a C corp since about 2009, you can have 100% of your gain up to 10 million not be subject to tax. That's an amazing feat. By the way, that also applies to dividends coming out. You can be taxed at 21% in the corp and then dividend the money out. If your stock is qualified small business stock, you will pay no dividend tax. So you could actually sell the assets of a C Corp at the federal level and get almost the same raise you would on a capital gain. So there's a couple of little tips right there on things that you can do based on your structure, based on I'm talking about the entity that you're selling, and based on structure, you just have to plan. This is another point on be proactive. Think about it in advance. When you start to think about selling, don't wait. Get it done in advance to plan through what's going to happen.
Good stuff there, Monty. And Darren, I'm going to put it back over to you. We alluded to this a little bit before about managing buyers' sell expectations. A lot of buyers are anxious on two fronts. One is we're companies where they know sales are delayed and they're hoping that rebound, they'll be able to benefit from that rebound and earn that income from delayed sales. And also they're also trying to take advantage of the SBA lending that's available. But that anxious nature of tendencies of buyers wanting to move forward without doing any in-depth due diligence can delay deals. And then sellers in reverse, a lot of things what Monty alluded to, not taking a look at their tax situation, what their net proceeds are going to be, and some of the tax saving structures that Monty mentioned. They're overlooking some of these things as well. And when you get to the closing table, everything kind of blows up and everything kind of comes out there at that point in time, as opposed to having been resolved earlier. What are some tips, some feedback you can give to buyers and sellers and assist them with managing expectation and what should be expected of them in the midst of a transaction?
Well, obviously, I'm not a business, but we do work with a lot of them. So the things that I've learned over time in the M&A market is one, buying and selling a company doesn't happen overnight. It does take some time. So it's best if you have the ability to prepare for it. Use that time wisely. Ideally, if I were advising somebody, you want to obviously clean up your books and records. You want to have a clean set of financial statements. You want to have clean tax returns. You want to pay tax. Obviously, those are things that most business owners don't want to hear. But the cleaner the records, the more marketable the business becomes. It's just like cleaning your house before you sell it. No different there. More importantly, though, beyond just those basic things is, you have to be informed. So working with somebody who can help you navigate through a lot of that preparation is definitely a key. Obviously, you want to make sure that you're sitting down with your tax professional. You want to have an advisor next to you to prepare the business for sale. If you're on the buy side, you want to have an advisor as well as a valuation professional. I think in any case, you want to make sure that the business that you're buying is at a fair price. If you're the seller on the other side, you want to make sure you can maximize the value of that business, and you want to make sure that you're able to make informed decisions, which means that regardless of what you want to sell your company for, you have to know what the value of it is first before you can do that. Sometimes that number is what you want it to be. Sometimes it's not. And if it's not, then you have to figure out a way to fill that gap. But I think when it comes to managing any expectation at all, you have to be informed. And I think if you surround yourself with the right people, you can do that. You want people to tell you what the situation is, not what you want to hear. Those are the right people that you want surrounding you, because you want to be able to make not only the right decision, but if you have to take some time to prepare or longer than you want, you have to be informed of that. And I think if you can just go into the process with that expectation, one, that it does take a little bit of time to prepare. Number two, the transaction doesn't happen overnight. And three, if you sell it at the right price, and if you have it valued in advance of that, I think you're in a better position to know what is ahead of you looking forward. And if you can stay informed about all of those situations, I think you're in a better position long run. Because if you do all those things, selling the business, while it does take time, won't take as much time as if you were to sell it without being prepared, without having the right value, and without surrounding yourself with the right people. I think if you do it right, you can minimize the time, maximize the value, and I think ultimately that's what you're trying to do.
Monty, you've been around a long time. Thank you, Darren. Good comments, good feedback. Monty, been around a long time with a lot of intermediaries. You've heard a lot of horror stories. Is any one thing that stood out that affected the sale, or if you want to give share a story or just a comment in general, and how best to manage the expectations on both sides of the closing table.
The quarterback is the intermediary. That's just a fact. The quarterback's the intermediary, so the worst thing that can happen is the intermediary doesn't remember that. Any intermediary should never, ever, ever allow somebody else to step in and be the one who is controlling the process ever. And so I don't care if it's the attorney in the deal or if it's somebody like myself who's bringing structuring and tax and all that knowledge and skill set is necessary. But the facilitator, the intermediary, has to stay in charge, and you never back off and let somebody else take over. In addition to that, one of the biggest things that you can find yourself is you don't have command of the information well enough that you don't already know what's coming. You don't let yourself get into due diligence. You want the buyer's expectations to be managed by the fact as the intermediary, you're in control. You know about what the information is. You don't let them find things that you're not already aware of. Hey, a great example is this. I was asked to review some information for somebody, and the buyer, the seller's intermediary, I asked them, "What are you doing about the built-in gain problem in this company?" And they said, "Built-in what?" Well, it was a C to S conversion, and it was still in the S conversion window. They didn't even know what kind of tax return they were filing. I don't know how that was. They were on the verge of closing a deal, and then they found out that they had a built-in gain problem, and the seller was about to lose about $600,000-700,000 of tax. Didn't even know it was happening. So you got to stay in the middle of staying in command and control of your information, and do this for the sellers right now. Do not allow the sellers and their frustration or their anxiety about what's happened in the COVID side get to them so that they now step out and try to force a deal to close quicker than it should. But that will be a natural tendency. Some of them are stressed out. They've seen a lot happen, and they saw the potential they could lose everything. They got a buyer at this point, or about to have a buyer who's willing to buy them. Let the process take its course. Don't let the seller step up and force this thing any quicker, because if they do, it'll send a negative signal to the buyer, and the buyer may react and walk away. Or they may do like one of the intermediaries just experienced on an advisory engagement I'm involved in, where the seller jumped in too quick. The seller would not allow the due diligence process on a couple of pieces to be completed. And the next thing I know, he knows he's got a couple $100,000 worth of escrow that they're demanding be held because they think something's being hidden. And it was simply a reaction from a seller who was reacting because they're scared because of what they perceived could have happened to them as a result of COVID. So stay in charge as a facilitator. You got intermediary, you're the quarterback. Don't ever forget that.
Yeah, it's good point. And here in New York, that's something we try to do as well. Try to maintain that control on both sides. Definitely maintain, and it's a collaboration as well. You want to make sure you converse with attorneys and CPAs on both sides so we can get to a positive scenario for both parties. We did have a question that came in here from the audience. We may have addressed this. We have addressed this before, but I'll throw it out there to you guys. How has COVID-19 impacted transactions between buyers and sellers?
In the broad sense, what I see right now is that COVID-19 has caused buyers to try to take advantage of sellers. That's one. They are trying to take that as a maximum deduction in the overall value. So the bottom feeders are out there trying to feed, and those who weren't bottom feeders are trying to pretend like they are. So now they're in here taking advantage. And then on the flip side, the sellers, they are not standing up and negotiating as strongly as they should, because they are still scared about what happened and what just happened with COVID. And if they got a buyer, they believe that if they stand up and negotiate too hard, that the buyer may go away. So sellers are being a little passive in their approach, and buyers are trying to step up and be overly aggressive and trying to get the value reduction on the thing it's not right or doesn't belong.
Right. Darren?
Well, I think a lot of the same thing that Monty had mentioned. Obviously at this time, there is a lot of opportunity out there, but as a seller, you've got to make sure that you can stand your ground and make sure that you're able to support the maximum value that you have to offer. Buyers are obviously looking for a good opportunity out there. You got, like I said earlier, you got to surround yourself with the people that can help you navigate through some of that. It's certainly easier with a seasoned professional on your side than doing it on your own. But I think beyond that, transactions are transactions. You want to sell a business and buy a business for a fair price, and I think if you can come together and doing that, then it shouldn't be a problem.
Mm-hmm. As we close off here, any final words of advice on our main topics, which is timing and valuation? Any closing remarks or words of advice for buyers and sellers that are listening to this presentation?
Well, I would say from the seller standpoint, the number one priority at this point, especially if you have been impacted in any way over the last couple of months, is keep your books and records up to date as much as you can. Do what you can to identify the rebound, and it's not easy to see. Obviously, when you're not working or when things are not coming in, and all of a sudden they start coming in. That's typically where the rebound is going to start. You want to make sure not only can you identify that, but you can support it with some type of financial record, because that's really what you need on your side. And I think from a buyer standpoint, it's the same thing. You don't want to put your transaction in jeopardy because you're underbidding on a company that really deserves more in terms of value. You've got to find that common ground, and you've got to find what truly is a reasonable expectation of what a business looks like going forward from a financial standpoint. And I think if you can do that, transactions will certainly be in a better light.
Monty, and same question to you.
Hey, can you hear me now?
Yeah, we can hear you.
All right. Hey, I missed that question. Our power actually went off. You may not have known, but our power went down. We're having storms here right now. So go ahead and ask that question. I'll be happy.
It booted back up pretty quick. You're back up. Your video is pretty clear, so actually it came back pretty good. It's good.
Yeah.
So in closing, any final thoughts or comments based upon our topics for today, which was timing of sale and valuation? Any closing remarks or topics? Any last minute nuggets you want to leave with our attendees?
Yeah, dude, don't be afraid. Don't be afraid of where you are in the market. Intermediaries have weathered through storms for years.
I think I may have lost you, Monty.
Yeah.
So yeah, I mean, it is a challenging time for all of us that are in business, and that's the whole point. You want to make sure you work with a professional, seasoned company that actually can handle your specific situation. So we went over a lot of topics here. I think we got majority of our questions answered and what we wanted to discuss. While we get Monty's feedback on, Darren, we have your website up. Is this a good place folks can get a hold of you? Anyone that wants to reach out to you for your services or any follow-up questions?
The website right there is current. Obviously, anybody who wants to reach out to us, they can. That line you see goes right to our office. There's a directory. If you find my name on there, just call me up. Happy to answer any questions that you've got.
Oh, thank you, Darren. Monty, I don't see a video feed. Are you live with us?
Hey, I'm back now.
Perfect timing, right at the top of the hour. We just any final comments?
You can hear me again?
Yeah. Any last comments or feedback and based on our discussion today?
Yeah, I'll say one last thing. Hopefully this power won't go off again. We're having very hard storms here. I was right in the middle of saying that as a facilitator, you've got to stay in command. Do not allow the market conditions or things in front of you to take control. Intermediaries have weathered storms for years, and there were times when you couldn't ever get funding and you had to do everything simply by seller financing. And so stay focused and remember this: you are your brand. As an intermediary, you are your brand. I don't care if you're working for a company and you're working with a firm, you still are your brand. Keep your brand strong. Get out there, show passion in what you're doing, communicate with and show leadership and communicate with those sellers. Lead those buyers by the hand. Stay in control. Stay in charge. But don't lose faith in what you're doing. Remember, you can only go as high as you're willing to allow yourself to go. Right. So when you get up in the morning, don't let you too stressed out about what's happening. Keep on going. Stay capitalized. Don't spend money that you don't have. So if you think a deal's coming, don't start spending it until the deal closes. Okay. So stay focused. Everything will be fine. We'll weather through all this.
Hey, Monty, I see you're weathering that storm in Texas as well. Looks like you're holding up pretty okay now.
That's right. That's right.
Yeah, it's been great. It's our ninth series in our M&A on-demand video series. So I appreciate Monty and Darren being part of this. Anyone wants to get a hold of Monty or Darren, their contact information is up on the slide. Thank you once again for participating with us. We are the NYBB Group. You can reach us at our website, nybbinc.com. Any questions, you can reach out to us as well. Thank you all. Have a great day. Be safe.
Thank you.
Thank you.